Ladies and gentlemen, stocks today came under a little bit of pressure, including Tesla stock. Now, yes, the stock was green today, but not as good of a day as you would have expected to see, given the PPI report came in so strong. Oracle raised their AI CapEx budget by 35%, something like that. Maybe it was 60%. Their projected AI revenue at $144 billion 4 years from now was break out the champagne glasses, as Dan Ives would say. Like, that was a gangbuster quarter. The stock up 40%. Larry Elliott becoming the richest person in the world, surpassing Elon Musk. Today was a huge day, is what I'm getting at. Yet, the markets were pretty tame. In this video, I will go over why that is, the big catalyst tomorrow that is critical. Now, we also have some clips from CNBC I will share with you that I think you must watch. Okay, one of the highest ranking analysts in the world today says there's a case for a 75 basis point cut in September. Now, I don't think that would be seen as good, but there's talk of larger and larger rate cuts to come. Now, as I've talked about before on this channel, I think we're going to have a very strong end of the year rally in 2026 because inflation does not show up and the economy holds up. If I'm wrong and the economy looks like it's weakening further, that's not going to be great. But I don't see that in the cards at this point. So nonetheless, we're going to talk Tesla as well here in today's episode. As always, hit that like button as well as subscribe to the channel if you have not done so already. And let's get into today's episode. Oh yeah, and just to clarify, Oracle projects $144 billion in cloud revenue by 2030 and boost their CapEx by 65% to $35 billion. Now, what analysts said about this today was as followed. AI is booming. AI is here to stay. Oracle shows that AI has longevity. Okay. Oracle was not only important, or I should say Oracle earnings and guidance were not only important for Oracle, they were important for the entire AI trade. As I've said on this channel before, I think one of the biggest near-term risks for markets, it's not a recession. We don't just walk into recessions anymore in this country. The economy is too diversified. You really need a shock event. And at this point, I just don't see it. Okay? But the risk is if AI were to become unloved again, if we had another DeepSeek moment or something worse than DeepSeek were to happen, that would be the biggest near-term risk for markets. And Oracle just basically said, we don't see AI going away anytime soon, basically forever, right? AI is here to stay. That was big from such a well-respected company like Oracle. Now, this is big for the entire AI sector. This is big for data centers. This is big for AI appliers and enablers, specifically Tesla, because Tesla is the world's largest AI applier. And I put AI into a couple different categories, really three main categories. You have AI enablers, NVIDIAs, TSMCs, the companies that make AI possible. They've long already had their wave. The AI appliers, Tesla, company, little known company like Resolve AI, Symbiotic potentially, okay? Couple of other names we could list there. But Tesla is by far the biggest real world applier of AI. Thus, it's going to be the biggest company in the world eventually. Think about the internet, which I think AI is a perfect parallel to the internet. The biggest companies in the world were not the companies that created the infrastructure for the internet. The biggest companies in the world were the appliers of that technology. Tesla is one of one. There is no other company like Tesla. It's funny because a lot of AI companies today are using AI to save money in operations. That's great. That's fine. That's good. Tesla's using AI to grow their revenue at what will be unprecedented rates. Tesla's market cap opportunity is massive when you're talking about robotaxi at scale and you're talking about humanoid robots. There has never been another total addressable market this large by dollars. Okay. It's like the iPhone or phone market, but for a product that's going to trade at 20 times the price. So it's 20 times larger by simple math's sake than the phone market. Again, assuming that anyone that owns a phone will eventually want to own an Optimus bot. Logically speaking, okay? So Oracle's earnings today were a massive green light for AI stocks, for the AI trade and AI revolution. If you do not see that, you have no sense in investing, and you should probably stick to S&P 500 index funds. You shouldn't strive to get rich in markets. It's probably not your forte, my guy. With that said, if you are still watching this video, you understand the importance of Oracle earnings today. Could something come out and change that? Yes. But not too often do you get a green light like this from Oracle or from another major large company, and then boom, the rug falls out from under your feet and you're stuck on your ass. You're not going to get, in my view, a DeepSeek panic-like moment for a while here. Okay, for a good while. So I do think Oracle earnings helps to greenlight the massive AI trade that I think is coming into the end of this year. I think it could get quite euphoric. But before we get to October, November, and December, what I view as what's likely going to be some of the best 3 months we have ever seen in our investment lifetimes, right? It's probably the best 3 months we've seen in at least 10 or 20 years, I think, is coming. We have to get through September. Now, some of the weakness that came to markets today, that came to Tesla even into the end of the day, is quite simple. People try to read into things way too much. If you understand markets, you understand exactly what happened today. While today was a great day, Oracle earnings, PPI coming in negative. We were expecting a 0.3% month-over-month rise in core PPI. Core PPI feeds a lot into PCE, which is really going to lower that PCE number. By the way, if you didn't know that, Fed's preferred measure of inflation. We have the CPI report tomorrow. That is a risk event. What Wall Street does ahead of risk events is hedge. It's pretty simple. They hedge because what could go wrong? Okay? Not what could go right, but what could go wrong, right? They hedge. In fact, a lot of people don't know this, but options are insurance. When you talk about options, you talk premiums. Okay? Options are technically a form of insurance or to hedge. So there's a lot of negative option flows today. There's a lot of shorting, which can be another risk managed way to hedge as well, as you know. There's a lot of puts being bought today and a lot of shorting happening today. I don't think not necessarily because people are expecting a bad CPI report, but because what if we did get a bad CPI report in September, in a weak month like September, seasonally speaking, that could be bad for markets. Now, I said this to start off this week. I said this on Monday and on Sunday, a couple days ago, that I thought there was a chance the CPI report would come in lower than expected versus higher than expected, but most likely around in line with expectations. Well, the PPI report came out today and showed no inflation, deflation. The odds are now in your favor if you're a bull in this market, that CPI is going to come in lower than expected. So the odds are pretty good that CPI is going to be a positive catalyst tomorrow. Now, for full transparency's sake, it is September. There is a seasonal bias to short and sell stocks to mitigate risk from a hedge fund perspective. So even if we do get a really good CPI report, it doesn't guarantee that stocks are going to explode higher on that like they should, right? You may see a weird move tomorrow, even on a really good CPI report. Why do you think indexes sold off into the end of the day today? Not because anything changed between Oracle earnings and the strong PPI report and the all-time high that we hit in the beginning of the trading day, but because we got closer and closer to that event risk, hedge funds and institutions started to hedge. Because again, if you're balls to the walls bullish heading into a potential risk catalyst, and let's say it goes wrong for you, you could lose your clients and your funds and your investors a lot of money. That's why you hedge, okay? So if we do have a good CPI report tomorrow, logically, you would expect to see a really good reaction to that. But in September, it may not be as bullish as it would be, let's say, if we got a really good CPI report in November, the strongest month of the year historically for markets. Keep that in mind. But for tomorrow's CPI report, for core month over month, you're expecting 0.3%, same as last month. Year over year core is expected at 3.1%, the same as last month. Headline inflation month over month is expected to rise to 0.3% from 0.2%, and headline CPI is expected to rise from 2.7% to 2.9%. So you are expecting to see around unchanged inflation tomorrow for core and a slight rise for headline. Again, based on the PPI report today, there is a very low chance that we come in on the high side tomorrow. That would be a very weird discrepancy if that happened, because PPI should, in theory, lead CPI. Producer prices go up, then they raise prices for consumers. Typically, consumer prices don't go up and producer prices go down. That would be good for margins, but bad, again, for the inflation story. So the odds are good tomorrow that you do get a downside surprise for CPI. Now, how much of that is priced in via PPI, I don't know. But if we were to see something like a negative CPI report tomorrow, yeah, I would expect stocks to do very well on that. Now, as we talked about in the last video, the rate cut odds did not move much today based on PPI because people are waiting for CPI, logically speaking. The odds went up a little bit for 50 basis point rate cut. If we were to get a negative CPI report tomorrow, I think we could probably be at like 50% odds for a 50 basis point rate cut in September. But most likely, we're only going to get a 25 basis point cut. Fine. That's great. But what's really going to move is October and December coming tomorrow's CPI. So for October, you're pricing in a 78.1% chance of a 25 basis point cut, a 5% chance of 3 rate cuts by October. So that would be a 50 basis point cut in September or October, and a 17% chance of only 1 cut by October. Markets are pricing in a 67.4% chance of another rate cut in December. So 3 rate cuts, a rate cut at each Fed meeting. If that CPI report comes in hot tomorrow, the odds of 3 cuts are going to fall. The odds of 2 cuts, which is currently at 25.9%, are going to rise. Okay. If the CPI report comes in really low, the odds of maybe 4 cuts moves up from 4.2% maybe to 20% or 25%, right? And the odds of 3 rate cuts probably going to fall in favor to lean more towards 4. So that's the big change that we can expect to see. Now, again, rate cuts are not in and of themselves bullish. They're not. The reason why the Fed is cutting rates is bullish. So if we just don't see inflation, that's great. But if we don't see inflation from tariffs because the economy is weakening, that's not good. There becomes a fine line between how much weakening is okay and how much weakening sparks a growth concern. Again, versus less rate cuts with better growth is probably good. Now, I think we have some strong tailwinds for us, okay? Big, beautiful bill, a lot of stimulative-like measures in that. That's great. We can look forward to that in 2026. Trade certainty hopefully comes soon. And we just came off of the best earnings season we've had in a very long time in markets. So, like, typically earnings don't just collapse the next quarter, like, unless there's some kind of huge event that happens. So I think Wall Street's looking at this and saying, hey, could we get some weakening around the edges in the economy? Sure. But earnings are largely safe at this point, unless there were to be some kind of utter disaster. And that's the way I'm really looking at markets as well. I'll take it a step further. As I've said before on this channel, I think the economic data is severely lagged behind. So I think some of the quote unquote growth scare or concern that we're getting in some of the data recently is linked to the trade embargo with China back in, May, late April, May, June-ish, right? I think that's some of the data sets that we're getting. So over the next 3 months, we're going to be getting more data from July, August, and September, and that's going to show a better than expected economy at this point. I think that's a tailwind, or will become a tailwind, that will help contribute to a very strong year-end rally for markets. And I think 2026 is going to be a year of consumer recovery, of low inflation, of many rate cuts, a lot of investment in America. Again, some of the tax changes in the big, beautiful bill, a stronger consumer, and a really damn good stock market. As I said on this channel before, I don't give a rat's ass what happens in September. As long as the fundamentals of my theory do not change, they remain the same. Okay? This is a well thought out theory. As long as nothing changes, I don't care what stocks say about it. I don't care what happens to Tesla or the next stock, as long as the theory does not change. Now, Tesla, I think, is really at the heart of, again, what the 3-month rally into the end of the year is going to be predicated around. I think it's going to be predicated around AI appliers, companies that are actually going out and seizing the opportunity from a business to business perspective or from a business to consumer perspective, like Tesla is, right? Mainly business to consumer AI, like robotaxi, real world AI. But I also think there's going to be a big trade in AI software as well over the next 3 months. And that is where I'm positioning outside of some of my positioning in AI. So, or Tesla, right? So we have Tesla as really the one big AI applier company, right? Real world AI applier. And then you have the other AI appliers that are business to business. Those are the software names. So yeah, tomorrow is going to be a huge day as far as the markets are concerned. Now, I did make a trade for tomorrow. Check it out, link down below in the description of this video if you would like to come get involved with the moves that we are making. What we are doing over there is going out finding high quality AI stocks before Wall Street does. Okay? Doing this, I think, lowers the risk profile and amplifies the returns. Let me put this simply. If you want to invest in high quality grade A companies, great. You're looking at Apple. You're looking at Walmart. You're looking at Nvidia. Yes, right? You're looking at these well-known, well-stable companies. You're not going to 10x those stocks, at least not anytime soon. What I'm doing is going out and finding the high quality stocks that have those kind of upside returns. You got to go in the small cap area most of the time to find opportunities that are just so overlooked by Wall Street to get these kind of returns in high quality names. But it's possible, and that is what we are doing. The trading community portfolio is up 139% year to date. I think it's going to be up a lot more into the end of the year, up well over 200% if I were to predict now. But hey, anything can change. I'm not a financial advisor. I'm not a financial planner. I'm not related to you. This is not financial investment advice. I do some reckless shit sometimes when I see opportunities. I'm not afraid to put a large chunk of my portfolio into one stock that I feel is a huge opportunity. And, when those come, we seize them, take advantage of them. Okay. But I'm not your financial advisor. Do not join this if you are a gambling addict. If you have a problem saying no, do not join this. You will lose all of your money. But if you want to come get involved with the best community in the world, check it out. Link down below in the description of today's episode. Share this clip with you from CNBC. It says Deutsche Bank's Binky Chadha on lifting its S&P target. They raised their S&P target from about where we're trading right now, about 6,550 was their year-end target, up to 7,000, which again implies about 9% upside from current levels, which is a lot in just the next couple of months. And I think it highlights if the S&P is going to go up another 9%, if that's what really happens, I think stocks like Tesla are really going to do well. Your AI names are going to do exceptionally better than that.
550 to 7,000. That's back to its original forecast from the beginning of the year. And that is now the second highest target on the street. Here with us with his call is Binky Chadha, Chief Global Strategist at Deutsche Bank. Good to see you, Binky.
Good to see you, Mike.
So the path of your target somewhat reflects the way the market has experienced this year, right? I mean, it's like a major scare. We needed to reevaluate a lot of things, tariffs, the economy, the Fed, and the markets, and now we've restored some sense of predictability. So why do you think there's more upside?
That's exactly right. I mean, the way I would put it is basically we had a big shock, or what seemed like a very big shock, the tariffs, and that really upended the market. It upended our views. We were very negative on the impact, but, facts are facts, and so far the tariffs don't seem to be having much of an impact on growth, much of an impact on inflation. Earnings growth actually went in the other direction and picked up in the second quarter. And if you listen to what companies say, they're basically saying that, yes, it's a shock, yes, it's negative, but it's manageable, it's going to grow. So we started at 7,000, so we're going back basically to 7,000. I would say forward-looking, key sort of way of thinking about where the market's likely to go is, obviously the market's at new high basically, and so that kind of suggests to most people that everybody's piled in, the market's overweight. Technically, the market is currently overweight, but that's all coming from systematic strategies. So all of the discussion about fundamentals and what we call the discretionary investors, their positioning is neutral, hugging neutral for the last 2 months.
Yeah.
That's one source of upside. We have a little bit built in for flows. And then there's buybacks, which is, again, back to earnings. So if earnings are fine, we think buybacks will be fine. You put those three things together, that argues for, as you noted, 8%, and that's back to 7,000.
How do rate cuts factor in? Does it matter if we go 50 or 75 by the end of the year? And I'm just wondering, are the reasons behind the rate cuts, does that override lower rates? In terms of lower rates, meaning, there could be a growth scare.
Sure. So what I would argue is, in terms of our view, it's really based on the macro, and it's really about the growth part of the macro and earnings. So I think rates are sort of important for, rotations and reallocations within the equity market. But I would say, right now, quite a lot is priced into rates already. So it has to be a notable surprise relative to that. I would argue it's not the short-term rates, but the more sort of medium and longer-term rates that matter. And they've already priced that in, and if anything, likely to go in the other direction if there's some disappointment. So near term, yeah, I mean, I think it's sort of a sideshow unless it delivers a really big surprise.
So let me know your thoughts on this down below in the comment section. Again, you have to understand that stocks like ahead of risk catalysts, something like CPI, just expect that you're going to get some selling pressure. And I think the selling pressure we've seen today into the close of the day, especially the back half of the day, sets you up for what could be a larger rally after a good CPI report, if that's indeed what we do get. So let me know your thoughts on this, again, down below in the comment section. Hit the like button as well as subscribe to the channel. Come join the trading community, link down below in the description of this video. We are going to close that off soon. Again, the idea was never to create a community so large that I can't get to know you on a one-to-one level, right? Like, that's not the idea. This is supposed to be a journey, a multi-year journey to prosperity. That's at least the way that I envision it, not to have a bunch of people like that I can't get to know, right? We have core groups over there right now, a core group, I should say. And what an exciting time to be in that group and to be an investor. Shout out to all of you guys that are a part of that community. Yunwan, No, freaking Task Force, Talon, Brock, Connor. I mean, all of you guys, man. How incredible. Micah, I mean, could go on and on. Some of the names are a little wild, but come join it if you'd like to. Have a great rest of your day, and I will see you in the next one.